the markets were rattled with tariffs. So kind of explain what that impact was and why stocks and investments that people have made may be feeling some bumpy rides ahead.
The biggest reason for the market volatility is uncertainty. That's really the biggest thing that investors dislike. And these tariff plans have created a lot of uncertainty for companies, for example, that don't necessarily know how much to charge for their product or where to make it or how many people to employ or what kind of equipment they need. There's a lot of uncertainty on the business side. Certainly for consumers too. We all know we've been dealing with inflation for a few years now. The good news is inflation's coming down. The bad news, tariffs could send that into reverse and lead to higher prices. So that's a worry on the consumer side. I believe it was the Mexican president who said, we can't go through this every 30 days. That's kind of where we're at now with tariffs. They're on, they're off. There's just a lot of uncertainty, back to that key word that Wall Street's worried about. The average consumer shouldn't worry about this market volatility. This is part of the normal ups and downs. A lot of the economic fundamentals are still pretty good. Goldman Sachs says there's still only a 20% chance of a recession over the next year. A lot of this is really more short-term volatility pegged to just business uncertainty.
So if someone does have investments and they're uncertain about the future of those investments, is there anything that they should probably change about their portfolio, or should they just leave things alone and kind of let it ride?
Just stay the course. To put this in perspective, the stock market, I'll say the stock market, I'm really talking about the S&P 500, the collection of 500 large stocks, that hit a record high 3 weeks ago. So it's not like we've rolled the clock back years and years. Despite a few recent down days on Wall Street, we're basically back to where we were 3 weeks ago, which is still pretty high. And that's really the main message. I mean, you go back a year and the market's up about 10%. So this is sort of part of the normal ups and downs. We do, of course, get more conservative with our investments as we age, or we should at least, but that's part of dialing back, risk on a normal scale. As long as you're appropriately allocated for your goals, your time horizon. I mean, look, a lot of people have decades until retirement. So money in the market is money that you should hopefully be okay with riding out for a while. Now, I mean, if this is your rainy day fund or money that you need in the next 6 months, that probably shouldn't be in the market to begin with. But as far as long-term investments, really nothing to worry about here.
And you make a great point about people being more conservative with their money, because that's a great segue into my next question, which was, are there any ways you can reinforce your finances in the face of volatility?
It's always a good time to take stock of where you're at. Maybe it's a good time to look at, am I appropriately allocated for my age? A rule of thumb is that your percentage in stocks should be something like 100 minus your age, or maybe 110 minus your age, reflecting that people are living longer. So in other words, even someone who's 60 years old, they might still be 40 or 50% in stocks. If you're in your 20s, I mean, you could have the vast majority of your portfolio in stocks just because you have a long time to ride this up. The market almost always goes up in the long term. Now, what it's going to do in a given day or week or month or even year is uncertain. But over the long haul, that's really what we're most concerned about with this long-term money. In general, I would say that a lot of the fundamentals are still good. The unemployment rate is 4.1%. It's gone up a little bit lately, but it's still pretty low in the historical context. The economy's still been growing. I know we've seen a few blips with, there have been some recent notable layoffs and consumer spending has slowed a little bit. The economy may be slowing, but it's unlikely to tip into recession this year. And the other thing is, this is by design. The Fed raised interest rates in large part to slow the economy in an effort to fight inflation. So this
Right.
is kind of part of the normal cycle here.
And obviously, we had a big metric that came out on Wednesday, which was obviously that consumer price index report for February. And it showed that rather than that 0.5% increase we saw in January, we had 0.2% increase in February, which is a lot less. So were you surprised by that news?
This was a bit of a good surprise that the inflation numbers came in a little bit better than expected. So I believe we're talking about 2.8% for headline inflation,
Right.
3.1 for core. I think I have those numbers right. So yeah, that's better than expected. That's trending towards the Fed's target. They want inflation to be 2%. Now, technically, they look more at a different inflation metric than the CPI, but it all sort of tracks back similarly. Some good news that housing inflation is not as hot as it has been. Just in general, this is kind of matching the Fed's playbook. Maybe they would have liked this to take place a little bit faster, but it's a gradual process. You picture kind of like somebody hitting the brakes on the car. You want to slowly apply pressure, or at least that's the Fed school of thought with the economy. They don't want to slam on the brakes. I mean, maybe in a car once in a while you have to do that to avoid a crash or a deer or something, but you don't want to do that with the economy because then that just causes a recession just right away. So it's more of a gradual slowing, and more or less this is on track. Now, that gets us back to the first point about tariffs and uncertainty and what's going on in Washington. That's sort of the yeah, but that a lot of investors are saying is, well, good, inflation's coming down, but is that going to continue if tariffs add to prices? That's adding to some of the uncertainty and volatility.
So is it safe to say that these tariffs could maybe impact that soft landing that the Fed was aiming to achieve? Because obviously everyone was saying you do want to be cautious about approaching those interest rate cuts. So could the soft landing be hampered by tariffs or unaffected?
That's the worry. And one thing I would note here is that this whole tariff thing is really self-created. It's not really related to the economic fundamentals. So it could be quickly reversed. We've already seen some of that. There were reports that certain car prices could go up $12,000 because of tariffs. And I know that sounds staggering, but the math works out. I mean, that's a quarter of 48,000, which is roughly the average new car price. And if there's a 25% tariff and that gets passed on to the consumer, it pretty much checks out. Now, when news like that broke, there was a quick reversal of, oh, we're going to delay the auto tariffs for now. And that gets us back to uncertainty, though. Delayed for now. It's a 30-day delay. So what happens after that? Does it get extended? I know the president would like companies to make more goods in the US. That's easier said than done in terms of labor and costs, and but also just how quickly can you spin that up? You can't build a new factory in 30 days. Now maybe you could move a little more business to an existing site, but even there's hurdles with supply chain and labor and all that. So it's actually a pretty complicated set of issues. But I do think that the fact that we've already seen some standing down on the tariff talk, I think could be comforting in the sense that these things could be avoided if necessary. I know the president thinks it's a necessary negotiating tool for the border and the economy and other things, but I would be more worried if we were seeing more significant erosion of the fundamentals, like if the unemployment rate was going way up or if consumer spending was pulling way back. The economy's in pretty good shape. A lot of this is more political noise that's affecting things.
Yeah, the economy he inherited was a pretty strong one. And obviously, we're seeing that inflation has been going down steadily for these past few months. And one thing that we always look forward to, the Federal Reserve cutting interest rates. Could we see an interest rate cut soon, or is it still going to be a wait before another one?
The Fed meets next week. They're not going to adjust rates next week, but a lot of people are going to be reading the tea leaves of what Jerome Powell and his colleagues have to say. May feels like it's on the table for a potential rate cut. If not May, then there's probably even a better chance of June. There are increasing expectations that we get at least one cut, probably a quarter point, by the midway point of the year. Best guess right now is maybe 3/4 of a point in cuts by the end of the year. The crystal ball gets cloudy the further out we look, but there is an expectation that rates are going to come down a bit this year. It's a fairly slow process, though, because remember, the Fed raised rates by 5.25 points in 2022 and 23, and they only cut by 1 point last year. So we're still significantly higher than we were in, let's say, 2020 or 2021. It's one of these things that, rates went up a lot in a short span to fight inflation. They're drifting down more slowly. So that has impacts on consumers. Mortgage rates have been slower to come down. Credit card rates are still near record highs. Car loans are still much higher than they were for most of the past 15 years. I still think higher for longer is kind of the message for borrowers, But we are seeing a bit of relief. Credit card rates are already at their lowest point in 2 years. Mortgage rates have backed off. They're actually at a 2025 low. Now, that's not saying a whole lot. I mean, they've come down like half a point. So a little bit of progress, but we still are hoping for more.
Yeah, and the one word you hear often brought up when we talk about inflation is housing for sure, because there's that shortage of housing combined with the fact that we're not building enough housing. And so it's always going to be a struggle in order to tame housing inflation. What role do you see monetary policy playing in how we actually solve this problem?
Monetary policy moves slowly and may not be the best instrument for something like housing. Really, what we seem to need is more housing, more building. And that's tricky with interest rates high, tariffs maybe adding significantly to the cost of lumber and other materials, labor shortage too. This crackdown on immigration could make it harder to find people to build houses. So those are all potential worries for the housing market. And there's also the big affordability question where prices are still at or near record highs. Mortgage rates are still elevated. It's tough, especially for first-time buyers. We're seeing a little bit of progress with housing. Renting, though, is more affordable in just about every market right now. And some of my advice for consumers would be that I know people want to buy a house, or a lot of people want to buy a house. There's no shame in renting. I mean, a lot of times that is a prudent choice for now. It gives you more flexibility for job opportunities. You don't want to overpay and put too much of your net worth in the house and not have enough left over for other expenses. So I know some people are in a rush, but I would say for a lot of folks, it's better to rent for another year than to buy a year too early. There's also this school of thought that says date the rate, marry the house, that if you are in a position to buy, even with rates elevated, maybe you could refinance in a year or two if rates come down. I wouldn't put all my eggs in that basket, but if we are talking about people that have the other boxes checked, they have a down payment, they have a cushion for maintenance and repairs and insurance, and they're going to stick around a while, it's not the best time to buy, but maybe it could still work for you.
Slow and steady wins the race, right?
Take that long-term view. Yeah, that's true for housing. That's true for investments. A lot of these personal finance issues. Yep.
Well, Bankrate Senior Industry Analyst Ted Rossman, thanks for joining me.
Of course. Thank you.